turn now to Jay Taylor. He's the president of Taylor Hard Money Advisors and the editor of MiningStocks.com. And Jay joins us now from the NYMEX with more. Hey, Jay, I know you're a long-term player here, but tell us what you think. There's been a lot of volatility in these prices. They seem to move quite a bit from one week to the next. What's your view on gold and oil at this stage?
Well, I mean, short term, it could go anywhere. And I think really what it's all about is a perception of liquidity and whether or not there's going to be a QE3 or enough liquidity around to allow this debt deflation process to continue in some sort of a controlled manner, because make no mistake, we are in a great debt deflation globally, and that is not necessarily good for commodity prices or for the global economy. So if we see a major contraction, or if there isn't sufficient liquidity pumped into the system to keep the system alive, then I think we could see plunging prices across the board. But I think Mr. Bernanke is making it known that he's going to pump as much money into the system as need be to try to avoid anything like happened following Lehman Brothers in 2008.
Jay, what is your forecast for year-end? We were just talking about those median estimates of analysts that we had surveyed. Silver up 45% by the end of the year. That's the median estimate. Gold, sort of a paltry 9.8% when you put it relative to silver. It sounds paltry.
Yeah, I think that's very reasonable if the system expands. If we continue to see the risk trade unless we see something like a Lehman Brothers, and God only knows, that's always possible with all the problems in Europe. But assuming the risk trade is on, silver will outperform gold when the expansion takes place. Vice versa, though, if we go into a deflationary collapse like we had following Lehman Brothers. And really, I would expect silver to outperform gold. In terms of numbers, I could easily see silver going back up to its highs and possibly taking out $50, and from there, the sky's the limit. The problem I have with coming up with price predictions is that we're predicting prices in terms of the U.S. dollar, which is a very unstable unit of measure, because trillions and trillions of new units of that currency can be created out of nothing, as we've seen. And that really is what the commodities are telling us. I think what gold and silver is telling us is that they are monetary metals, and they are rising beyond, we started at gold at $255 10 years ago or so. So we are having a great credit deflation, though, and longer term, I think that's extremely bullish for gold. And I like to look at the real price of gold. What will an ounce of gold buy? And I measure it against the Rogers Raw Materials Fund. And if you look at what an ounce of gold would buy prior to Lehman Brothers in 2008, in July of 2008, an ounce of gold would have bought about 17% of the Rogers Raw Materials Fund. That rose to 44% by March of 2009. It trailed back to about 30%, went up to about 42% with the first Greek crisis, and now it's back up to about 39%. And what that means is the purchasing power of gold has risen dramatically. Silver, likewise, has held up very, very well. And as the system expands, again, I think silver becomes, because it's an industrial metal as well, and if the system and the risk trade is in expansion, silver will outperform gold. But if we go into a collapse, a deflationary collapse, then history shows, and the 1930s being the most recent equivalent time frame, then we could see gold outperforming silver and everything else except possibly paper.
So, Jay, quickly, you mentioned industrial metals. What about zinc? What about copper? What about aluminum, nickel?
Yeah, well, I think zinc, you can make the case for zinc is very bullish right now, assuming, again, the absence of any kind of major credit deflation. And if we can muddle along and like we are now without any kind of major problem, then, and the world's economies hold together kind of, and Asia continues to grow 7-8% or more, then I think you can make a good case for all of those base metals. And I think zinc in particular looks pretty good because there aren't any new supplies coming on, any major new supplies coming on. And in fact, there are some zinc companies that I've started taking a look at that I think, zinc mining companies that look very, very attractive.
Can you share which companies those are?
I'd rather not right now because I need to tell my subscribers about them first.
Okay. Well, tell me about some of the companies that you are willing to speak about, whether it's related to gold or silver that that you feel very strongly about.
Okay, one I really like is San Gold. trades on the Toronto Exchange, SGR. They're about $1 billion market cap. They're trading at $3. There are 300 million shares outstanding. What I really like about it is they recently added new management. Robert Peary, who was a very high-level operations guy at Placer Dome, joined the company, and since he's joined the company, their operations are going swimmingly well. We're seeing them under promise and outperform. This is a company that is going to spend $25 million this year in exploration and drill 300,000 meters. And Robert Peary told me in an interview I did with him that he expects their resource to go up, their gold resource to go up exponentially, is the word he used, and he's a cautious man. So I think that's one that I really favor at this point in time. They're producing, they're cash flow positive, should start to show earnings. They are in the Red Lake district, not far from Gold Corp's Red Lake project. And the Rice Lake project, this is called, is one of the, I think, one of the most outstanding high-grade gold discoveries in recent times. It's in Manitoba, Canada. It's really one I like a lot.
All right, Jay, we have to leave it there. Do appreciate you joining us on this show today. And we'll keep a lookout on the website to see what those silver mining companies that you mentioned. Thanks so much.
Thank you.